Buy or sell the New Zealand dollar versus the US dollar. First off, read this disclaimer carefully. And do your good deed of the day by liking and subscribing. So we go here and look at these pairs. So here's the New Zealand dollar / the US dollar. US dollar is the quotes. And we have a 1.45% move from the 52-week low, but we have a 9% pullback so far. So that is, very substantial in the Forex market. So here is the big picture. Weekly data points, and we do see that there are these time cycles. They were super nice and clean. Rise, decline, rise, decline. It was almost like printing money. Rise, decline, but as of late, there's been some disturbance in the force. So the time cycles, they are probably still relevant, but they've kind of been messed up. Of course, the situation here we had with the lockdowns, and there was a lot of pandemonium in the repo market, and so it actually was much bigger than the lockdowns. And there's been some theories that the lockdowns were also necessary to, and also the monstrous money printing was very necessary to save the dollar system. Okay, so what we currently have here is an interesting situation where we have a very key moving average in play. And that is the red 200-week moving average. It has been support before. We are currently testing it for support again. The reason why we know that this moving average is such a big deal is because it's also functioned as very clear resistance. So it is definitively a level that's watched by many market participants. So I do think that as long as that support holds, I would lean bullish. Beyond that, we also have an inverse head and shoulders pattern in development. You could argue that this is shoulder, this is head, and that this currently is a right shoulder being formed. Something that corroborates, head and shoulders pattern being tradable here for this this pair. That is the history. So there's been a bunch of inverse head and shoulders pattern before. You could argue that this is a more messy inverse head and shoulders pattern. It did lead to some rally, especially if you bought near the low of the right shoulder. Also here, there's a bunch of inverse head and shoulders patterns. So here we have a smaller one, which led to a rally. You could argue that this is a very big one. Huge left shoulder, huge head, and a big right shoulder, and then we did see a very, very nice rally. And we can go even further back. So yeah, you could argue that there's multiple head and shoulders patterns here, inverse head and shoulders. A left shoulder, a head, and maybe this was the right shoulder. Here could be a monster inverse head and shoulders pattern, like that. So the history here with inverse head and shoulders pattern is very interesting. And that substantially increases the probability that bulls will feel a bit more confident about the current price action and put on a bigger position. So I would lean bullish here, but it's not like super high conviction. It is just that there's something afoot. On the daily data points, we are below a bunch of moving averages, so there is a bunch of resistance here. So if we do get an inverse head and shoulders pattern playing itself out, that doesn't mean it's going to be like a straight trip to the upside. There is going to be some turbulence. Looking at these other indicators. We are at some lower levels here on some of the PPOs, also the RSI, but we are not like at key lows. Neither here on the daily data points. It's a bit noisy. So I think that for the thesis, the bullish thesis, I think that the 200-week moving average support and the inverse head and shoulders patterns, I think they are like the key parts of it. Okay, so here is the seasonality. So over the last 5 years, then January and February have been weak, meaning the New Zealand dollar tends to weaken vis-a-vis the US dollar. Over the last 10 years, then you do see that it becomes a bit more complicated because there's a strengthening from January into April. And looking big picture over the last 20 years, you do see that there is this strengthening. So we go here from, January being, a bit 50-50-ish, but then February, March, and especially April is strong. So yeah, there is this increasing strength here on the seasonality that it means that the bears are going to most likely have lower conviction, smaller positions, especially those big institutions that put on massive positions, because they need a bunch of time to get in and out of their trades. So when they see like that there's a very strong seasonality on the horizon, then they are going to be a bit more careful, and that could be beneficial for the bulls. So here is the correlations. So 72% with the S&P 500, 33% with gold, and 72% with Bitcoin. So very strong actually here with Bitcoin, and minus 88% with the dollar index. So it is interesting that even though this is the New Zealand dollar / US dollar pair, the negative correlation with the dollar index is only quote-unquote 88%. Some might think it would be like 95% or something like that, but no. Looking at the daily data points, then we only have a minus 67% negative correlation with the dollar index. So that is why it's so important to look at correlations, because there's many people who don't put on certain trades because they assume that there's this extreme correlation. But obviously the math is calculated right here in front of us, and there's not like some perfect negative correlation at all. There's a lot of price action between this pair that is simply not explained by looking purely at the dollar index. And that kind of logical fallacy is something that I also see when it comes to major indexes. So some people will be like, look at the S&P 500, and if something like good is, if the S&P 500 as an example is in an uptrend, then they are going to assume that any stock in the S&P 500 will also be in an uptrend. But when you then look at the correlations, then you see that that's not necessarily the case. Okay. So 34% negative short term with the SPY, 16% with gold, and 17% here with Bitcoin. So the Bitcoin correlation is much lower here, shorter term. So to sum up my take on this pair, I do think that there's more reasons to be bullish than bearish. The bullish thesis is certainly more longer term. We looked at the weekly data points, so it's more bigger picture. So this is just this is a very interesting setup, and the seasonality could help it out, especially more towards April. But the thing is that the bigger institutions, they will start to prepare for the April strength pretty soon, because they need time to smoothly get out of positions. So yeah. Whatever you do, of course, you always want to have a stop in place. And in this case, I think the 200-week moving average in red was decent as, some stop level. So yeah, I mean, the closest thing to like a free lunch you can get in this market is to actually use stops. And that is something that they say in the Market Wizard books, interviews of the best investors of all time. They are very clear, pretty unanimous. The biggest revelation they had when they started in the market is that you must use stops. I mean, most of the interviews actually contain some story about them not using a stop, then they get killed, and then they start using stops from there on.